The finance manager's computer screen showed two numbers, 6.2% and 9.8%. The customer would see the higher number. The dealer would pocket the difference. On a $60,000 loan, the interest difference over the loan term would be significant profit. And the customer? They'd never know they'd been overcharged. This is the moment Marcus Thompson lost a significant amount of money without realizing it. March 15, 2019. Priority BMW of Fairfax. Thompson walked in with a substantial cash amount and a good credit score. 4 hours later, he'd signed papers that would haunt him for years. But here's what makes this story different. We have the receipts. David Chen was the man behind that computer screen. For several years, he worked finance desks at multiple BMW dealerships across Northern Virginia. He kept records, he saved emails, and in October 2022, he broke his silence. What he revealed will change how you see every car dealership forever. But first, you need to understand the significant financial question. How does a software engineer who debugs complex code for a living get systematically overcharged by a car salesman? The answer isn't what you think. Chen's records show first-time buyers paid significantly more than they should have. This wasn't random price variation or market forces. This was a system. And it starts with two words that should terrify every car buyer: payment anchoring. Here's how they hook you. The finance manager never mentions the total price, never discusses the real interest rate. Instead, they ask one simple question: what monthly payment would make you comfortable? The moment you answer, you've lost. But you don't know it yet. Thompson said $600 per month. That number became his cage. The dealer structured everything around hitting exactly $600 while hiding a significant markup, extending the loan to 72 months and locking in an interest rate higher than his credit qualified for. Thompson thought he was being responsible. He was actually being overcharged. But here's where it gets darker. Those market adjustment fees, often fiction. Chen's internal emails suggest it. A message from Priority BMW's general manager reads, "Apply market adjustments to any BMW X3 or 3 Series because customers expect to pay extra for luxury vehicles and rarely question these fees." Many of these fees had no basis in reality. The real genius lies in something called rate bumping. BMW Financial Services approved Thompson for a lower financing rate. The dealer quoted a higher rate. They pocketed the difference on the entire loan amount. This isn't a markup on the car. This is taking money from the bank's approval and calling it profit. Priority BMW staff meeting. Owner James Morrison announced that the finance department had generated more revenue than actual car sales for the first time in company history. He praised the team for maximizing customer investment and announced bonuses for finance managers maintaining high profit margins. Chen sat in that room and realized he was part of something predatory. But here's what nobody expected. The customers who got overcharged were more likely to default within 18 months. The inflated payments created a cascade of financial destruction. Thompson had to sell his BMW after 11 months when a job change made the payments unmanageable. The system wasn't just taking money, it was destroying lives. This goes far beyond BMW. A Consumer Financial Protection Bureau study found many franchise dealers nationwide use payment anchoring and rate manipulation. First-time buyers paid significantly more than experienced buyers for identical vehicles. Dr. Patricia Rodriguez, the CFPB economist who led the study, called it a significant wealth transfer from consumers to retailers in the automotive sector. The manufacturers know. Internal BMW North America communications obtained through Freedom of Information requests show executives actively encouraging dealers to maximize finance profits. An email recommends gross profit margins per transaction, with specific instructions on using extended warranties to justify inflated payments. Chen's decision to expose this system affected his career. After providing documentation to the Virginia Attorney General, the Virginia Automobile Dealers Association blacklisted him. He can't work at any franchise dealership in the state. The investigation resulted in significant fines against several Virginia dealerships. No criminal charges were filed. But here's the most disturbing part. Chen described training sessions where finance managers practiced emotional manipulation techniques. Time pressure. Social proof, preventing customers from reconsidering decisions. The materials specifically targeted first-time buyers because they lack experience and are more likely to trust dealer recommendations. The significant financial figure represents cumulative damage across multiple vehicle purchases. Chen's analysis shows buyers who fall victim once are likely to get exploited again because they never learn the warning signs. The compounding effect often exceeds the cost of an entire additional vehicle. Thompson discovered the truth later when he tried to refinance through his credit union. Loan officer Sarah Kim showed him documentation proving he'd been approved for much better terms. By then, he'd already paid a significant amount in unnecessary interest and fees. He filed a complaint, but never recovered the money. The industry's response? Double down while improving public relations. The National Automobile Dealers Association published a statement defending market-based pricing. Meanwhile, internal communications show dealers becoming more sophisticated at hiding markups and manipulating customers. Here's what shocked Chen most. Fellow finance managers genuinely believed they were helping customers by maximizing monthly affordability, even when those deals cost tens of thousands in additional interest. This cognitive dissonance allows the system to perpetuate because the people implementing these tactics don't see themselves as predators. Federal regulators have proposed new disclosure requirements. The automotive lobby has successfully delayed implementation multiple times. First-time buyers continue losing thousands to practices that exploit their inexperience and trust. Chen advocates radical transparency, requiring dealers to disclose actual bank approval rates alongside quoted rates, itemizing all fees before payment calculations, providing standardized comparison sheets showing total costs across different loan terms. These changes would eliminate most predatory financing profits, but restore trust between dealers and customers. Your next car purchase doesn't have to follow this script, but only if you know what to watch for. The real question is, how many other industries have perfected similar exploitation systems that we haven't even noticed yet?